Okay, here we are, week 2 of finance class, and these are the lecture notes that go along with the work we're doing in class, which is sort of a combination of reviewing a little bit of financial accounting, refreshing our memory about what's in the financial statements, as well as doing a little bit of different analysis that we do as finance professionals. That's a little bit different from how you learn this material in financial accounting and managerial accounting. So here we go. Financial statements. Woo! All right. So first thing, we need to talk about the difference between finance and the other financial classes that you've had before. Finance, broadly speaking, it's about trying to increase the net worth of individuals and increase the equity value in companies. Um, Finance is all about looking into the future. When should we buy new assets? When should we sell assets? And always with an eye towards how buying and selling assets will improve your bottom line and improve your net worth, your equity position. Um, Basically, it can be considered to be those kinds of activities that create or preserve the economic value of the assets of an individual or a small business or a corporation. And, so that's the field of finance. And then financial management is all about making the right financial decisions, making the financial decisions based on the best available information that you have, knowing that the future is unknown, right? So finance is about how we make decisions about long-term asset positions when we don't know what the future holds. So how do we account for risk? Finance really is a combination of economics and risk. Now, there's four major areas of the world of finance. Corporate finance, which is, making financial decisions within a company setting. And then there's investments, which is really sort of like, there's investments as they apply to corporations, but we think about like investing in the stock market, investing in the bond market, et cetera, the kinds of things that individuals, the kind of decisions, financial investments that individuals can make, as well as, of course, corporations make them too. And related to both of those is the field of financial institutions and markets, which we will touch on in this class to some degree, just because in order to understand investments, you have to at least have some background in financial institutions. If you are interested in that topic, the economics department has classes in money and banking, which would have more about that. And then there's also the field of international finance, which is really an advanced level of study. It requires you to have a foundation in all these other areas of finance and then apply it to the question of, different exchange rates, different financial institutions that facilitate international transactions and, different currencies and things like that. That's beyond the scope of what we'll do in this basic finance class. So really, we're going to be spending our time the first half of the class on corporate finance and sort of the basics of how financial managers make decisions in an environment of uncertainty. And then we'll do quite a bit of work in the investment world, because I know that students are into that. So that's what we're going to be doing in this class. So now some of the things that financial managers do really is to determine, how best to pay back borrowed funds. So making sure that you have all the cash flows that you need in order to be able to pay all your debt. Make sure that there's also enough cash in the bank to be able to run the business. So it's a lot about cash management. But the goal is to make investment decisions and financing decisions that maximize the cash flow to the firm and therefore maximize the current stock price. The current stock price is related to what investors think the future cash flows of the company are going to be. That is the foundation of the current stock price. So the thing is that it's not necessarily about profit maximization. You can't have positive cash flows in the long term without being a profitable company. But profit is not the same as cash. And that's what we're going to be really focusing on in this first sort of set of homework and example problems is try to really get our heads around what cash flow is as opposed to what profit is. Now, there are 4 primary financial statements. All companies have to file them, and looking at these 4 financial statements will tell you everything you need to know about what's going on with a company. Because remember, from financial accounting, every transaction that occurs in a business gets recorded in a certain way such that you generate these standardized statements. So every company's income statement, whether they're big or small, is going to be reported in the same sequence of accounts, and it's going to be reported in this according to the same rules. And so what that does is it allows you to compare one company to another through their financial statements. And because it's such a standardized way of reporting, you can look, once you get good at this, you can look at financial statements and know exactly what's going on in a business. Exactly what's going on, right? And so they're all related to each other. Now, we're not going to actually touch on the statement of cash flow right here in this first couple of weeks of class. What we are going to do, though, is look at balance sheets and income statement and retained earnings statements and see how they're related, right? And so here is a schematic of how they're related. We have our beginning balance sheet, which tells us our assets, or what we own, and the assets have to equal the liabilities plus the equity. We know this, right? And then that goes into the beginning retained earnings statement, the beginning value for the retained earnings. And then during the course of the year, your company generating income, it's generating revenues, and it's paying expenses. At the end of the year, you calculate up what your net income is, right? And that also goes into the retained earnings statement as the net income or loss. And at the end of the year, you also take a snapshot of your company and you add up all your assets, you add up all your liability. So the income statement, balance sheet, and retained earnings statement are all intricately related to each other. Each flows from the other. At the beginning of the year, you take your balance sheet, you take a snapshot of your company, which consists of your assets, which are what you own, and the total value of all your assets has to equal the total value of your liabilities, which is what you owe, plus your equity, which is the net worth of the company. And the equity accounts are the contributed capital, or the original money that went into the company from the investors, and then your retained earnings, which is all the profits that you've kept in the company. So at the beginning of the year, you have a balance sheet. Over the course of the year, you generate, you run your business and you generate an income statement over the course of the year, and that is your revenues, and then you subtract out all your expenses in a certain order, which we've gone through a little bit in sort of the previous, the review material, but we'll continue to hound on this later on in this lecture. And then at the end of the year, you also take another snapshot, and that's your ending balance sheet, where you have your new value of your assets and your new value of your liabilities, and then the difference there is what your company is worth, what the equity account is. To connect your beginning balance sheet and your ending balance sheet, and specifically to connect the retained earnings value, or the value of the profits that have been kept into the company, you have to do just this quickie little statement called a statement of retained earnings, where you take your beginning retained earnings from your beginning balance sheet, and you add to that your income statement. You subtract from that any dividends that are paid. Dividends are also called owner's withdrawal or payment to owners. That's what dividends are. They're payments to the owners. And then that leaves you with your ending retained earnings, which goes back into your ending balance sheet. So that's how the 3 primary financial statements are related: income statement, balance sheets, beginning and ending, and your retained earnings statements. Okay. So I think I'm going to stop this video here, and then we will continue on with the next bit of material. Okay.